All right, welcome back to the channel, everyone out there on YouTube. Thank you for tuning in to another video today. I am going to discuss something that a lot of traders out there fail to understand, okay, because I get the question pertaining to failed entries, why and what causes them to actually happen, all right? Everyone thinks that once a demand or supply zone is created and price comes back to it, it should automatically reject it, right? Bounce from it, allow them to take an opportunity, whether it's for a quick scalp or for a running position or whatever the case is. But either way, allows them to get into a great trade setup. That is not always the case. I always tell everyone, okay, you have to remember one thing. When we as traders, regardless of what markets you trade, there's one thing we always have to keep in mind. Who drives the market? We as retail traders do not put a dent in the market, okay? We simply do not have the capital to make or push the market in any given way. We have to be able to grab the coattail, follow behind what smart money is doing, okay? Yes, I'm talking about smart money moves because you have to understand hundreds of millions and billions of dollars are funneled through the markets, all right? And that's by the banks or institutions, hedge fund firms, whatever the case may be, placing orders, okay? They're transacting at key levels within the market, okay? And they are the ones that create these levels. So understand how they move, when they move, and be able to move with them. Now, what I want to show you on this chart here was kind of a representation from yesterday, but a little bit different. I want to clear the airwaves, all right, and kind of clean up and answer some questions at the same time. Because one thing I always get all the time is, why did my level just not hold up? Okay, why did the market blast through that area of demand? Okay, and come down and test another area of demand. All right. No one 100% has an answer for that other than smart money. The banks, institutions simply just did not want to transact at that key level or zone, okay? You have to understand that they're the ones that choose where they want to transact at, where they want to fill orders at, where they want to turn the market back around and keep it pushing in a certain direction. So we just have to, wait for the opportunity, and patience is really the key. I keep talking about that because when price gets back to your zone, you want to wait for some confirmation, okay, some confluence to be able to take a trade, all right? Just don't blindly jump into an entry the moment price taps into the zone you've been waiting for. It could have been, you could have a level or zone set up and you'd be waiting patiently for a day or two for it to come there, and then it gets there and then just blasts right through it, all right? And then you're sitting here scratching your head trying to figure out, wow, I thought I was going to make some money, or someone showed me a strategy that if I just wait patiently till price gets back to that zone, then I can make some money. Don't ever get to a point to where you're pointing the finger or blaming someone else, okay? Strategies work, depending on the strategy, okay? But they do work if you are following the steps to take or to engage in that strategy or execute at a certain zone at the right time. But there are steps that you must follow, and that's why I always talk about a breaker structure, looking for price to come back to an area, looking for order block or demand or supply zone. Those are the same thing. And then simply waiting to see if there's aggressive buying or selling that is at that area, looking to see if there's an imbalance or gap. The things that I talk about that I look for when price is moving to the upside, trending, making higher highs and higher lows, or moving to the downside, making lower lows and lower highs. I'm looking and waiting patiently for retracements or pullback to key areas of supply and demand. Now, I want to show you here because, again, people are always frustrated and are impatient, I guess maybe learners or impatient to waiting for, price to get to a zone to where it really wants to reject. Meaning the banks and institutions are now ready to move the market in a certain direction. They're ready to take price to a certain level or zone, and then they're saying, okay, we're ready now. This is the area where we want to fill orders at, all right, and we're going to move the market this way, okay? So take a look at what we have right here. Just think about the market trending in a certain direction, okay? It's making higher highs and higher lows, okay? We got a high here, a higher low. So the market is moving up. All right, we are bullish. All right, higher, a high here, higher low, higher high, higher low, and then a higher high. So the market is moving where? To the upside. All right, we've got a break of structure as price move to the upside. Pull us back, another break of structure, making a high right here. Now, once we see things like this, okay, price taking out areas to where there is, you know, where price is taking out highs. So basically, when we talk about a break of structure, I'm looking for a new high to be taken out or a new low to be taken out, okay? An area where there was pretty much liquidity resting at, you know, a nice area to where price pushed up here, and it may look something like this most times. It's an area pretty much where price has retested the top a few times or the lows a few times, creating an area of liquidity, meaning it's making equal highs or equal lows. So the market is kind of doing something like this, okay? Okay, it's doing something like this, kind of just bouncing back and forth, creating like maybe a crown top, if you want to say that. So it's making equal highs at the top here. It pulls back, boom, breaks through structure to the upside, okay? So, and that can happen on the flip side to the downside. So we're looking for an area of liquidity to be taken out at the tops or an area of liquidity to be taken out at the bottoms, all right? This case here, because we're moving to the upside, we're taking out an area of liquidity at the tops, all right? So when price is making this, you know, this structure breaks to the upside here, all right, most traders are waiting patiently for price to pull back to a key area of demand where there is an imbalance or a gap in, okay? I said this in videos before. Imbalances or gaps back at an area of demand or supply are going to give you a higher probability chance of when the market gets back to that zone to be able to get into a play, to be able to get into a position to where you can profit, all right? But you have to wait. The most important thing once price gets to a zone, even though it's created a demand area in this case here, and you had that imbalance, okay, or that gap, or whatever the case is, all right, and prices pull back to a discount area here. We're running the Fibonacci from here to here, all right, we're below the 50%. Demand's down here. We got aggressive buying to the upside, so we're in a discounted area. Guess what? The last thing we need to do is wait patiently. Most traders fail at trading because they are impulsive and impatient. They have to be in a trade at all times, or the moment price taps into their zone, they're in that trade. And then the market turns around and then it just pushes lower, okay? And we're going to talk about why that happens, all right? I want to show you that, okay? So you waiting patiently for price to get back to this area right here. And then you jump into the trade the moment it gets here and you're ready to take the market back up. And then guess what happens? Boom, it blasts right through you, all right? I see so many new traders, so many beginner traders put themselves in a predicament to where they blow their account real quick because first of all, they have not or don't have enough capital or did not put enough money into their brokerage account to trade with, all right? Look, if you're trying to build up a small size account, you got to have some patience, all right? You have to be able to wait for the trade setup to unfold for you if you want to slowly build your account up, meaning being able to get into a trade and make profit, all right? Little by little wins the race, not jumping in and going for the full gusto, okay? So look, price gets there, traders jump in, boom, they take the trade trying to go to the north, you know, going back up, and the market blasts right through that area. Now I'm going to show you an example of what's going on, okay? What's going on? Look, price is climbing to the upside here, right? So we got an area of demand right here as well, where there's an imbalance or gap here, and it breaks structure right here. The same type thing, below the 50% area back here, we're in a discounted area where we can get into a position going long. So take a look at what just happened. It just broke two means of structure, meaning now we have an area of demand here and an area of demand here. You have to be mindful and when you're reading your chart, okay? Following market structure, looking at price action, looking at what took place as the market was moving higher and breaking structure. Multiple areas or zones of structure were created, meaning multiple demand zones, okay? So we got a demand zone here, 1, demand zone here, 2. Price comes back, you jump into it, and then it comes down here. Why? You may be asking yourself, okay? I'm going to explain to you now why this possibly, in most instances, happens. When you see this occur, and you see you have a zone here and then a zone below it, wait patiently. Think Think. Be more logical than just jumping into the trade. So price gets, it blasted this area here and it comes down here. Now, take a look here. As I said before, using this diagram as an example of what you would see on a regular candlestick chart, okay? All right. So when price pushed hard to the upside here, lots of buying, right? Leaving behind this area of demand. It left an imbalance right here, okay? All right, as it moved to the upside here. So if we have an imbalance here, say at the bottom, okay? Say the top end, so with price, say this is our last red candle to the downside, and then a green candle takes that red candle out to the upside. So let's say there's an imbalance from that area, say right here, okay? And then price moves up, but then it pulls back right here. So then we have this gap that's left behind, all right? From where the imbalance was created, meaning this is an inefficiency right here. Inefficiency that was created right here, meaning a gap right here, okay? The market moves to the upside. The imbalance happened once price, or that candle took out the last red candle to the downside. It pushed up, all right, and just blasted to the upside here, leaving this gap, okay? It did continue pushing to the upside, so you can picture this as being green candle, green candle, green candle, green candle. Then it pulls back and tap, and as far as it comes, it's right here before it pushes higher, okay? So it left this gap right here. Price at some point is going to want to fill that imbalance. It's going to. It's definitely going to. When, we just don't always know, but we can always assume and wait patiently for something to happen once price gets back to the demand zone where there's an imbalance, all right? So once price broke through this area here, you've got to ask yourself, well, what just took place here, all right? Yes, there was an imbalance that may have rested right here. I'm waiting patiently for price to get back right there, but look what happens. Where there is your zone at, your demand zone, there's always, right there at the end of it, there's going to be more likely, that's going to be liquidity. That is liquidity right there. At every high or low, it's an area, it rests in an area of liquidity. But definitely so if you have equal highs or lows that are being built up, or whatever the case is. But this is a low here as price pushed to the upside. So this is liquidity resting right here, even though we have a demand zone, okay? So what do you think price is going to want to do? Think about it logically. Price comes down, okay? There's liquidity resting right here. There's an imbalance. There's a possibility it can reject there. But think logically. The banks always want to do what? Collect liquidity. They always want to stop traders out. So where liquidity rests at, they are running stops. They are trying to stop traders out as well. They know traders who went long right here had their stops resting back right here, and that's liquidity resting there. They are going to want to collect on that liquidity at the same time, fill this gap of this void right here, okay? Fill this gap, all right, imbalance right here. Come back down, all right? Tap into the next area where there is a imbalance and where there's the demand that rests at, aggressive buying to the upside. And then that's probably where they're going to transact at. So again, understand that. They are wanting to, they see liquidity resting right below. They know there's an imbalance there. They're going to bring the price back there. They know traders who went long right here are sitting here, and they're like just sitting ducks waiting to be, just taken out. All right. And that's what they're waiting on to capitalize. Take the liquidity, fill the gap, tap in here, boom, blast to the upside, okay? So lots of traders always think that because we have this last breaker structure to the upside and then price folds to the downside and it breaks a low right here that we're automatically going to start pushing lower. No, this is the first attempt to the run to the downside, okay? Yeah, we broke an area of structure to the downside, of course, right? Broke that area of structure to the downside, but we got a low, but we did not, and then we followed it with a lower high here, but we didn't follow with a lower low going to the downside. So to me, ultimately, price has not shifted in the opposite direction yet, okay? Even though this is more of a start of a bearish cycle or bearish setup to the downside, this could be just a deep retracement to stop traders out, grab liquidity, fill in areas of imbalances down below to push the market to the upside. You have to think more logically than just trying to jump in every little or setup that you see or every demand or supply zone you see. You've got to pay attention and look at the chart as a whole. Every move they make, you have to understand what's going on, okay? And think about it. It's like a game of chess, okay? They created a zone here, broke structure. They created a zone here, broke structure. But they've got liquidity here, but they know, hey, why not take out this area here, come in and fill the imbalance here, okay? We captured some money, took out some traders here, captured some money. we grab the liquidity, which is going to give us that power or that boost just to push the market to the upside. Think about it that way. Each time they take out liquidity, okay, say they took it out to the downside here, ultimately the market was trending to the upside, a deep retracement to take out liquidity down below, okay, it's just like a boost of a power pack. You know, it's just like playing Pac-Man in a sense. Remember that game as Pac-Man was going around and it had to eat certain things to energize itself to take out the ghost, okay, and to get to where it wanted to be at, ultimately having to take out everything in that, you know, that grid or that maze. Think about it like that. In a sense, price has to come down. It wants to take out liquidity. It gets energized here. It taps in, fills all the imbalances. Boom, blast to the upside. Think of it like that, okay? So we're going to move over to the chart now and take an example or look at an example what I'm talking about here in reference to, you know, one, price taking out an area of liquidity. It broke to your first zone and then it taps into a zone below, okay? Everybody thinks that, oh, there's a zone here. Why didn't it stop here? Okay, think logical, guys. Think about it from the standpoint of what makes sense. I want to take some money. I'm gonna take some money and then fake traders out at the same time. People start to think that now the market is pushing lower. You're gonna have sellers. So what do they do here? Sellers start to jump in. Sellers jumped in right here. Boom, the market goes lower. They are taking the ride to the downside. Yes. Okay, they think the market's gonna push lower. Market stops here after collecting this area of liquidity, fills the imbalances, breaks to the upside. Those same sellers are right here. Guess what? They got ran. Stops got ran. Here and here. They collected liquidity back up to the upside. Okay? Think about it. All right, so I'm saying, let's take a look at the chart now. Okay, so an example right here, we see price moving to the upside, making higher highs and higher lows, right? So it made a high here, pull back. New high, pull back deeper, okay? Right here, okay? And then it pushed higher, pulled back, and broke higher. So we got, we'll go ahead and mark this right here. Use this. We got a high here, new high here, and then a new high here, okay? Look, price pushed up, made a high here. It made a new high. I mean, excuse me, a higher low. A new high here, pulls back, breaks structure to the upside, makes a new high, pulls back, breaks structure to the upside here, okay? And then look what happens, okay? Look, it's created areas of liquidity, demand, which yes, there's liquidity at the bottom, at the back ends of them. Below, there's a demand zone sitting right here within this breaking structure to the upside. Look at this aggressive buying that came out of the zone. And it left behind an area or a gap, okay? A gap. So if we look here on the first area where there's a breaking structure, the gap was after the break of the last red candle here to the downside, okay? Pushes up, makes a new high, it pulls back, and there's a gap right, okay? So there's a small area, a gap still here. There's an imbalance right there, okay? So price pushed up here, all right? So then traders are looking to say, all right, price broke structure here. Where could it pull back? I would expect for price to probably pull back to this zone or this area right here. If you pull your retracement and you say you want to buy in a discounted area. So if we kind of did that, let's do that from this area here to the top right here. Down at this 50% area right here, a lot of traders probably looking at this area here as a possibility because you got aggressive buying to the upside right here, but you got aggressive buying to the upside right here at the lower area. Now, what you have to be mindful of here is that when price after it made its high here and then it did made a higher low right here and broke to the upside with aggressive buying, look, that last red candle to the downside here, and then it broke to the upside. Look, it already filled that gap or the imbalance right there. When it pushed up right here, broke right here, this next candle wicked out. It came back and touched that area that it left with as an imbalance. So to me, this is it could be a lower probability setup, but because the imbalance had already been filled, all right, meaning that now this has been a mitigated area here with no imbalance or gap is left behind. You have to kind of look for your next area if you're interested to look for a higher probability setup. Now, in this area right here, we just mentioned that this was the 50% or slightly below the 50% area on the fib retracement, right? Now, I'm not trading fib levels. Once again, I just pull up to see where we are at in reference to a discounted area to take a trade from. Break a structure to the upside. Price pulls back to this area. Most traders will say, oh, I'm going to get into a trade right here. Aggressive buying to the upside, that broke structure to the upside. And look what happens. It does not go in your direction. If you did not wait patiently for the break of a candle meaning price to break a candle in the opposite direction, which I do, which is part of my means of looking for when getting into a trade, waiting for clear definition or clear means of a rejection. Guess what happens? Price continue to push lower. So I'm looking for a break of a candle in the opposite direction to get into a trade on a pullback to where price left a gap at, okay, or an imbalance at, meaning the area was not mitigated yet. But when price gets back there, it did not provide any means of rejection. What did it do? It blasts right through this whole, look at it. It took it out. It took out, grabbed liquidity down here at the bottom. You see that? Grab that area of liquidity there. Traders that went long here got stopped out, okay? So it grabbed that liquidity there. It taps right into this high, higher low, boom, break to the upside. This breaker structure to the upside where demand rested right here. It tapped right into that area right there. And then what happened? It took off back to the upside, okay? Now, you know, it may not come back up here and take out liquidity here at the top end, but you just trade it, you know, appropriately. You trade it based on knowing what took place here as price kind of moved to the downside here, okay? So price could, you know, bounce at certain levels as it moves higher. But once you get the full rejection here, price tapped into an imbalance or gap, an imbalance here where aggressive buying was here, where there was a break of structure. And if you look at it, you can take your fib retracement, low to the high here. We are below the 50% area in a discounted area. You know, you look to go long when price gets back to it. Took out liquidity. It grabbed some sugar. It grabbed some energy. It grabbed some punch to be able to, when it took out these traders right here and grabbed liquidity, tapped into the demand area below and took off, okay? So you wait for the break of candle to the upside here. I'd probably get in right here, more likely at 41. Boom. Ride it up, you know, and it actually stops at 56 before it pulls back and then pushes higher. You see that? Now, there was, let's see, pretty much a supply zone resting right here. Aggressive selling to the downside here as it broke through lower here. I would have gotten my trade here at 41 and take it and probably taking out right here at 50, around that 50, around that 49, 50 area. So you get in here at, you know, 41, you can get yourself a nice clean 6, 7, 8 points right there, taking it back up to this area of supply right here, okay? So I'm showing you on the charts here what could possibly take place when you have multiple areas of demand stacked up on top of each other. A demand zone here coming out of this breaker structure to the upside, pull it back, breaker structure to the upside, demand zone resting right here. Price was not satisfied when it got there. It blasted right through it, took out liquidity, stopped traders out, grabbed that energy, tap into the next demand zone below, tap into it, boom, took off, okay? I hope you guys understand that, and I wanted to really just kind of dive a little bit deeper to answer the questions to individuals out there that are a little bit frustrated, get confused as to what took place when price got back to them a solid demand zone where a gap rest at, where there was clear, you know, lots of buy-in at. But you got to understand that sometimes when you have liquidity resting right here, look, there's no further break of structure to the upside. Once price broke this area of structure to the upside, nothing else, okay? There's just liquidity resting right here. But they see demand resting down here below where another break of structure took place at. So stacked up stacked up demand zones where liquidity is here, but they got a demand area here where there's an imbalance and needed fill. Why not, like I said, run the stops here, grab the money, tap in, fill the imbalance, and push the market back up? It makes sense, okay? Understand that, okay, guys? Look, if you're interested in joining a great Discord community, you can find the link to the Discord down in the description portion of the video below. We are Future Traders here, and on that channel or a Discord server, you will find a channel that's titled Trading Floor, and that's where we as traders come together on a weekly basis when the markets are open. We share our trade entries, okay? Screenshot them, put them on Discord, so that other traders can see what levels or zones that we're actually trading from. And it also helps, you know, individuals understand maybe your strategy you're using as well. You know, I explain my strategy throughout this whole channel here on YouTube. You know, multiple videos back to back. I have tons of live traded recording sessions where you can actually see me actually take my trades live, whatever the case is, and I explain in detail. But I really go into detail even more so if you become an elite member, which is one of the YouTube tier membership programs. You click on the membership tab on the homepage of this channel here. Up top there, somewhere near the subscribe button, you'll see a little link that says, or button that says membership. You click on that, there's two tiers. There's the loyal channel supporter, and the elite member tier. Most everybody who signed up is signed up for the elite membership. Why? It's $6.99 a month. Simply for the price of a cup of coffee, you get the trade breakdowns. When I post my trade entries or post videos covering the trades that I take, guess what? All right. Now I'm constantly taking trades. I'm trading on a daily, but not every single day that I post the actual trade breakdowns. But there are tons of trade breakdown videos already populated or posted that are made public to those that are the elite members. What I'm trying to say, okay? These are private videos now that are posted just for the elite members, those that subscribe or enroll in the membership program through YouTube, okay? Again, you get the trade breakdowns where I go in detail about my trade entries as if you were sitting next to me. And you also get the links to the playlist of videos that I've hand selected that I find which would be pretty helpful, especially to new traders or beginner traders. And maybe you're someone that's interested in maybe learning a new strategy surrounding supply and demand, whatever the case is. But anyways, I'm not an educator, I'm not a teacher, I'm not a mentor. I'm just basically sharing with you my style of trading openly and freely to the community, you know, through tons of videos that I have here on the channel. But for those that really want to dive a little deeper and enter into some access of watching and understanding the trade breakdowns, as well as you know, gathering that list of play videos that they can watch, you know, become an elite member. That's all I'm gonna say, you know, by simply clicking on the membership tab on the homepage here on YouTube. Okay, I appreciate all those and everybody who's currently a member. I appreciate it. We get tons of members that sign up daily. Thank you for doing so. Thank you for supporting the content creators, you know, content. Okay, that's basically what you're doing. You're supporting me as a content creator, being able to elevate the platform here to grow. All right, because that's what it's all about. And you know, I just thank everyone out there who's currently signed up. Thank you for doing so. Okay, but before you leave today, if you are not a subscriber, please take the time to go ahead and subscribe by clicking on the red button below. Make sure to click on the bell next to it. Turn your post notifications on so you never miss one of the uploads here on the channel. And lastly, make sure to drop a like on the video by smacking that thumbs up button. See you in the next one. Take care. Have a great rest of your weekend. And I will see you guys next week when we start doing and getting into more live trading. Take care.